Good day and welcome to this important unit in fundamentals of entrepreneurship. As an entrepreneur, you agree with me that every business activity that one embarks on, there are a lot of risks and uncertainties that surround every particular business you may think of. So there are threats around, there are dangers, and it's important that an entrepreneur goes into some business with that awareness. Very important. Spotting an enemy before you're spotted is critical. So today we want to look at risk management. So we'll try to talk about what a risk is and what are some of the sources of risks and how can we mitigate, prevent, or completely avoid all the risks so as to make the business a little bit safer. Very important. So let's try to define then what a risk is. So you agree with me that in every type of business, be it in farming, be it in grocery, it can be in merchandising, manufacturing, there are always targets. So an entrepreneur may set targets, and those targets can be attained, sometimes overscore, sometimes underscore. You fail to meet the target. At times you end up losing everything. So that deviation from the expected standard is what you call a risk. When you are planting maize, agriculturists will tell you that a 5 kg seed will give you this number of bags if you use these quantities of fertilizer and chemicals. Then you're going to have this number of bags. It's not always the case. At times you may put in much but you get less. So that difference from the expected standard is what you call a risk. So we can define a risk as any deviation of the outcomes from the expected standards, and that outcome can be measured, can be quantified. It's numerical in nature, it's statistical. Then we can say this is a risk. Since the risk can be measured, can be quantified, can be calculated, then it can be insured. So a risk is insurable in the sense that it can be quantified. Now you realize that there are certain dangers surrounding the business that you cannot ascertain, that you cannot quantify, cannot predict them. It's difficult to compute and predict the likelihood that it will happen. In such scenarios, we call that uncertainty. So uncertainty is any likelihood away from the expected standard that you cannot measure, cannot compute, cannot quantify. It's not statistical in nature. That's uncertainty. So in business, there are risks which you can calculate. The reason why they say always go for well calculated risks. There are also uncertainties, those deviations or variations that you cannot estimate, you cannot predict. For example, lightning. Lightning may happen anytime and you cannot predict. So the insurance company may say lightning is an act of God, therefore it cannot be insured. It's It's important that in business you are able to identify what are the potential risks and to what extent you compute, you calculate. Then could there be uncertainties? You also think about them, reflect about them, and see possible measures that you can put in place. Let's move further to look at some of the sources of risks. Now, you agree with me that risks can come out from anywhere, can pop up anytime, and it's difficult to itemize all the possible sources of these risks and uncertainties. However, we can categorize the sources for the purpose of this course into four. The first one is production risk. There could be some businesses that are into production, be it a restaurant, takeaway, be it a salon, be it farming, gardening, name them, poultry, and to production. There are always risks that are there as you are producing, as you are manufacturing, as you are processing those goods, meeting and so forth. There are certain risks that may emerge in the production process. So all those types of related risks can be classified under production. For example, when you're buying meal in the name of breakfast, you're not expecting to find super roller or roller meal, meaning the grinding meal, the hammer meal, must produce as expected. Any deviation, any variation from the expected standards, super or breakfast meal that we know, will make the customers cry foul. We are cheated, and the business may lose a lot of customers. To some extent, some customers can even sue that particular business because the production process was not okay. So it's a threat to the business. Hence, the systems must be checked, must be perfected, and just make sure that everything is up to date. Otherwise, you see a lot of risks coming out. When you are in some restaurant, you're buying some shima or whatever, fries, chicken and chips, shawarma, whatever, there is a standard you're expecting. Any deviation from the expected standard, it will make customers cry foul. When you're buying shima, you're not expecting to find lumps inside. If you're buying fried carpenter, you're not expecting sand to be there. Anything in the process which is not okay, it will chase away customers. That will make the business lose a lot of money. So in the production process, it's important to pay particular attention to details. When you are baking bread, a loaf of bread is measuring 500 grams and the machine is not working properly. Instead of 500 grams, it's producing 450 grams. Customers buy, they realize bread is finishing faster. They try to put it on a scale, it's weighing 450 grams instead of 500 grams. Tomorrow, they go to the courts and sue the company. Why? It's not producing as expected. The business will lose a lot of money and it will lose customers. It's a potential risk. So there are a lot of risks that can emerge in the production process. It's important that as an entrepreneur, you are in the awareness that as I'm producing these products or services, any carelessness, any fault, it may affect the business. The other category is technological risks. Every business is embracing technology for growth, to automate things, to reduce the wage bill, because things can be automated. Where 100 people are working, only 10 may be required. The rest can be automated. Now you realize that this technology may not function as expected. At times it may perform below par. That will lead to some variation in the expected level of service or performance or products. So any variation in the process will be a risk to the business, and the business can lose a lot of money. Someone in some dryer at some salon is expecting wet look to be produced. In the process, someone's head is roasted because the dryer is malfunctional. When from the one who is setting it is at 25 degrees, it's automating itself to 90 degrees, close to 100 degrees, which is the boiling point. By the time someone's coming out of the dryer after 10 minutes, the entire head is roasted, wounds all over. Someone goes to the hospital. The hospital says hair cannot grow anymore on this head because the entire skin is roasted. That other day, this lady goes to the courts and sue the business for destroying the hair or destroying the skin on the head. And the business will lose a lot of money. The business will also lose customers because people be fearing to have their heads roasted. It's a potential risk. So technology must be tested, must be checked every now and then to ensure that systems are working as expected and things are up to date. There are other risks that are found also in the pricing strategy as well as at the market. The market can be surveyed. Yes, the price of chickens, the price of tomatoes, price of rape, a bag of rape, cabbages, this is the price. You go to order, by the time you bring tomorrow, the prices go down and you incur losses. So prices may fluctuate. That fluctuation, if you're not careful, you incur losses. It's about calculating. It's about reading the market nicely. At times, certain products, you cannot predict the price. You go to buy dollars in Congo DR because the dollar is quite expensive in Zambia. By the time you are coming, Bank of Zambia has put up measures to control the dollar, which is increasing in value compared to kwacha. And you realize now the dollar is selling cheap on the market. You're going to incur losses. So pricing, marketing risk, these four under one category, we are learning them so as to understand that in whatever business you are dealing, the prices may fluctuate. The market dynamics are always uncertain. It's important to be in the awareness and do the calculations, do your homework well if you are to maximize those profits that you might be thinking of. Very important. The other category is finance risk. As you are borrowing, as you are lending, borrowing for the business, lending to increase your capital, there are a lot of risks. People may borrow and go for good. They borrow, go and die. They borrow, they go and become unwell, and they take long, eventually the business is suffering, you become bankrupt, and liquidate thereafter. The business closes. At times you may borrow from this bank for a period of 5 years, then Bank of Zambia that other day increased because of the inflation rate, and the bank decides also to increase the period of paying or the amount to be paying per year or per month, which you didn't think of, didn't plan for that. And instead of paying for 5 years, you end up paying for 7 years. In car losses, the business suffers because you didn't plan for that. Or instead of paying the 5,000 per month, you start paying 7 because the bank realizes they want to get their money within that stipulated period. So those are potential risks that are involved, and it's important that you are in the know-how. Now, how can we control? How can we mitigate these risks? What are some of the methods? Number one, diversification. Do not settle on one particular business. If you realize this one is stable, because waves continue coming one after another. So put up another business venture somewhere. Put another one. If it's stable, put up another one. Look at Dangote. He has several businesses in one group of companies. So he may be in oil production, in sugar, in cement, and name them. It's about diversifying. Why diversify? Because if one business is affected by risks and incur losses, the profits made elsewhere will offset the losses made in business A. And like that, you continue growing, you continue going, and you chase the BP away. So diversify. If you are working, you're a civil servant, you're an employee somewhere, diversify. Yes, you invested in education and it has paid off, and it's giving you income every month, but that income may not be there perpetually. Employments come, employments go. It's important to diversify. So the incomes we're getting every month, start another business, start several businesses until you realize you can be on your own, can stand on your own and become your own boss. Diversify, that's the critical point. 2, go for stable enterprises. There are certain businesses that are not stable, and look at the market, which businesses are stable, and quickly go for such particular businesses so that you reduce stress, reduce chances of having BP and the like. Insurance, go to the insurance company, establish the risk, and pay for that. In case of any fire, in case of any theft, the insurance company will come in and foot the bill. Flexibility, be flexible in business. If you realize there are some trends, there are some prediction, be flexible. If customers are saying this, use feedback and adjust quickly so as to meet the expectations of the customers. Be flexible in business. What are other ways and means of mitigating risks? Go for the spreading of sales, where you realize after harvesting 1,000 bags of maize, don't sell everything in June, July. You can spread the sales. You sell a quarter, 250 bags in June, then keep 3 quarters, sell another quarter somewhere in October, another quarter somewhere in December, and the remaining quarter you sell it in January or February when the price will be at hike. Why are you spreading? So as to sell at least during the time when the price will hike, will hit the highest amount. And if you sold everything in May and the price increases, let's say in January, you'll be regretting how I wish I kept my maize, my produce. So it's important to spread the sales, because a lot of uncertainties. You may not know, maybe some markets will open in the neighboring country, Congo DR, or any other country, and the government allows you to export. So it's important that you spread the sales where you can. Hedging. This is the process of selling products through some broker. You realize you are not good at selling, don't have marketing strategies, you can bring some people on board, sales representatives who will be going door to door selling for you, and they're getting commission. It's a strategy that the Undi Kingdom could use. Motakazembe used it, and the Bemba Kingdom also using the Imbangalas as the middlemen when trading with the Arabs. Sometimes they could use the Swahilis, to trading guns and powder and so forth. So it's an old strategy, and you just need to identify technical individuals that can help you reach the masses while you are in the comfort of your home or of your office. Someone selling, then they're getting commission. Hedging, very critical. The seventh point is going for contract sales, where you realize, FRI, before we grow maize, can we sign that the price of maize will be at 500 kwacha, and not where you dictate price for us? Or you go to this cotton seller, I want to grow cotton, let's agree that you buy this much. Or you agree with the secondary school, want to be supplying tomatoes to this boarding school at 200 kwacha per box, you sign. Then you start planting. Why going by that? You know what you're going to put in, you know the produce, and you know the expectation, including the profit margin, meaning you are very much aware of the profits that you are likely to get, and you are going into this business because of the profit margin that is very attractive. Going for a minimum support price, this is where the government comes in to cushion certain products. Sometimes the government may go for subsidies where they subsidize the products, and if you can venture into that, then well and good, because the government will be giving the difference, and you can sell as much as you can to the consumers. Net worth, to avoid bankruptcy, to avoid going insolvent. Always keep some monies afloat. Always keep some money in the coffer, because we don't know the possible outcome as they are trading. You don't know certain unforeseen eventualities that may befall the business. If you've got money, quickly you can use it to mitigate. So always have some money by your side in case of any risk that you're likely to face. As you are planting, always have some money to buy chemicals in case the farm is terrorized by the armyworms. So it's important that in every business, at least there is something by the side to fall on in case of anything. So these are some of the ways and means of mitigating the risks, and there are a few revision questions that you can reflect on. Number one, define what a risk is. We said it's a risk refers to any variation from the expected outcome, variation of the outcome from the set standards, and that variation can be computed, can be calculated, then we can call this is a risk. And you say there are different types of risks, and however they are classified into four: production, marketing risk, technological, and financial or finance risk. What are some of the ways and means of mitigating risk? So we talked of diversifying, going for stable enterprises. We talked of insuring the business. We talked of contract sales, hedging, where you sell through brokers. We talked of spreading the sales, among others. Thank you so much and best wishes.